Hey everyone, welcome back to the channel. Today we need to talk about something that almost nobody in the mainstream property world wants to say out loud. There is one single metric that has predicted every major British housing downturn in modern history. Not house prices, not mortgage rates, not affordability ratios. It's days on market, and right now, across the United Kingdom, that number is flashing red. If you've been watching the headlines, you'd think everything is fine. You'd think the market has stabilized. You'd think falling mortgage rates are about to reignite another mini-boom. But when you strip away the spin and look at the raw data coming out of HM Land Registry, Rightmove, Zoopla and UK Finance, a completely different story emerges. And it's not a story about recovery. It's a story about a market quietly repricing in slow motion. Let's start with the number that matters. Homes listed in December are now taking between 85 and 95 days to sell. Just a few months earlier, back in March, similar properties were selling in 45 to 55 days. That is nearly double the time sitting unsold. When properties stop moving quickly, that is not a neutral signal. It is the earliest warning sign that demand is weakening relative to supply. And here's where it gets more serious. Over a third of all properties currently listed have already had at least one price reduction. The average cut sits at around 7%. That's not a tiny trim to spark interest. That's thousands, sometimes tens of thousands of pounds being wiped off asking prices. Sellers are blinking first. Now let's zoom into London, because London has always been the bellwether for the entire UK market. Prices there are down year over year, roughly between 1 and 2.4%, depending on which month you measure. Sales volumes have collapsed by 21%. When transaction volumes fall that sharply, liquidity dries up. And when liquidity dries up, prices don't adjust smoothly. They gap lower. This is where the official narrative starts to unravel. Yes, mortgage rates have fallen from their 2023 peaks. Yes, wages grew faster than house prices last year. Yes, Boxing Day traffic on Rightmove hit record levels. All technically true. But record website clicks do not equal completed transactions. Browsing is not buying. Inventory tells the real story. There are more homes on the market now than at any point in the past 12 years. Supply is up nationally, and in London alone, listings are up roughly 14% year on year. The southeast and southwest are also running higher stock levels. A healthy market absorbs rising supply with rising demand. That is not happening. Transaction forecasts from UK Finance show stagnation rather than growth. We're hovering around 1.2 million completions. That's not expansion, that's flatlining. When supply rises and demand stalls, sellers compete against each other, and competition among sellers means price cuts. This is exactly why days on market is so powerful. It's the canary in the coal mine. First, properties sit longer, then sellers reduce, then comparable sales start coming in lower, then surveyors adjust valuations, then lenders reduce loan sizes, then buyers' purchasing power shrinks, then offers fall further. That feedback loop is already in motion. Let's talk about the premium segment. Properties above £2 million in prime London areas like Kensington and Chelsea have effectively frozen. Buyers are waiting. Sellers are pulling listings rather than accept discounts. That is not strength. That is denial. Even outside London, the picture isn't reassuring. Some northern regions are still showing nominal gains of 2 to 3%. But with inflation hovering around 3%, those are real terms declines. Adjusted for inflation, UK house prices are down significantly from their 2022 peak. It doesn't feel like 2008 because nominal prices haven't collapsed. But in real purchasing power terms, the market has already corrected heavily. And then we get to the mortgage reset wave. Around 1.8 million fixed-rate mortgages are set to expire in 2026. Many of these homeowners locked in ultra-low rates around 2 to 2.5%. Today, the average 5-year fix is above 4%. If they roll onto a standard variable rate, it can exceed 7%. On a £250,000 mortgage, that difference can mean hundreds of pounds extra every single month. For households already stretched by rising council tax, higher water bills, elevated energy costs, and food inflation, that jump is not trivial. It is destabilizing. Some will manage, some will cut spending, but some will be forced to sell. Add to that a cooling labor market. Unemployment has ticked higher. Youth unemployment remains particularly elevated. Wage growth is slowing. When people lose jobs while carrying larger mortgage payments, forced sales increase, and forced sellers don't negotiate from strength. They accept whatever clears the debt. At the same time, landlord dynamics are shifting. Rental growth is slowing, and in some regions rents are falling for the first time in over a decade. When yields compress and regulatory pressures rise, some landlords exit. More supply hits the market, but first-time buyers are constrained by deposits that can take years to accumulate. In London, average deposits exceed £100,000. Saving that on a median salary while paying rent is extraordinarily difficult. So we end up in a strange environment. Supply is rising, demand is cautious, mortgage resets are looming, rents are softening, inflation is eroding real house values, yet headline forecasts suggest prices will rise 1 to 3% in 2026. Even if that happens, if inflation runs higher than nominal growth, real values still decline. This is what a grinding correction looks like. Not a dramatic crash with 20% nominal drops in 12 months, not panic headlines every day. Instead, it's a slow erosion. Longer selling times, more reductions, slightly weaker comparables each quarter, quiet downward pressure. And here's the uncomfortable truth. The UK property market hasn't avoided a correction. It has been in one for 3 years when adjusted for inflation. The reason it doesn't feel catastrophic is because nominal prices haven't imploded. But real wealth tied up in housing has been bleeding away month after month. Days on market exposes that reality. When homes take twice as long to sell, when a third of listings are reduced, when transaction volumes collapse in the capital, that is not stability. That is repricing. Could things stabilize? Yes. If mortgage rates fall materially, if wage growth stays strong, if unemployment remains contained, the market could find a floor. But expecting a return to 2% mortgages and explosive price growth ignores structural constraints. This is not a boom environment. It is a fragile equilibrium under pressure. If you are buying in 2026, negotiating power may shift increasingly toward you. If you are selling, pricing correctly from day one will matter more than ever. And if you are holding, understanding that real values may continue drifting lower is crucial. Watch days on market. It warned before previous downturns. It is warning again now. Ignore it at your own financial risk. If you found this breakdown helpful and you want more data-driven analysis without the spin, make sure you like this video, subscribe to the channel, and turn on notifications. I'll see you in the next one.